How are you? So we are into the final session, final over. Uh, Today we discuss the last session, and I have shared some additional documents with you. Did you get the copy of additional short notes that I have shared on financial infrastructure, payment and settlement systems? There was a separate note other than the slides. Did you get it? Or let me see your response. Maybe some of you, maybe on the chat box. So what happened? Did you get the handouts I shared on the financial infrastructure? Can someone respond, please? Otherwise, I can make arrangements to. Hello. Can I ask someone, let's say Aman sir, did you get this handout, please? Just let me know. Not the slides. There was a separate handout on the financial infrastructure. Actually, a short note. All right, you get it, right? Thank you. At least finally, sorry, responded. Now let me turn back to the discussion today. Financial system stability and safety net mechanisms. Now, I think I mentioned to you at the very first stage of this course, the financial market or the financial system actually in a broader sense, it consists of several subcomponents. We have seen there are financial institutions, financial markets, financial instruments, financial infrastructure. All these components are part of the broader financial system. And we also understand there's another component, very important component, which is safety net mechanisms. Why safety net mechanisms are important? That ensures the stability of the financial system. So in this session, we'll be looking at financial system stability and safety net mechanisms that are available in a financial system. Now, being the last session, you cannot think that it is not really important. If you look at your paper, there are questions related to this financial system stability and safety nets. So which you cannot ignore this topic as well. So it's a very important part. So we will be covering the most important aspect of this topic. So let's start with financial system stability first. What do you mean by financial system stability? I think when we were talking about central banking, we had some discussions on this aspect, financial system stability. So very broadly, we can define financial system stability as the kind of a situation that a particular financial system is safe and secure in the face of external and internal shocks. I'll repeat it again. A financial system stability cannot be determined or defined as a safe and secure financial system which is able to withstand external and internal shocks. So there are some important words here, safe and secure. Sometimes you can call it sound financial system, which is able to withstand. Withstand means you have some resilience, right? resilience signaling kino orottu deno. Some resilience is there for what? For the shocks. So shocks are coming from the external economy and internal shocks. What do you mean by external shocks? Now, for example, let's say a global financial crisis. It's an external shock. High oil prices. It's an external shocks. So those are coming from the outside of the economy. Internal shocks are basically which are generated internally in the economy. For example, low economic growth, a recession. Now what we have today, COVID, is a kind of an internal shock. It's a global thing, but internally also in the economy, we have this shock. So if a particular financial system can, withstand, can be resilient against these certain shocks, then we can say there is financial system. So why do we need a certain stability in the financial system? In order to create a better environment for depositors and investors, we have to have a stable financial system. Because depositors and investors are people who are bringing money, funds to the financial system. We know depositors are investing their money in banks. Investors are investing their money in financial instruments. So both these stakeholders have to be protected in the financial system. So you have to have a sound, safe financial system for that. And also, in order to have effective functioning of financial institutions and the market, which are kind of intermediary institutions and entities in the market, are encouraged to actively participate in the financial system and perform their duty if the financial system is stable. So that is also an important thing. Broadly, the financial system is important for investment and economic growth. There is a clear link between the economic growth and stable financial system. I think in the very first lecture we have seen there is a clear link between the broader economy and the financial system. A good economy has a good financial system, vice versa. So in order to promote the growth, you have to have a stability in the financial system. We have seen when the financial systems are unstable, the economic growth is affected. Now, the best example is GFC, which means global financial crisis. So during the global financial crisis, we have seen financial instability, and that created a global economic crisis as well. Now, when you say stability, how do you identify whether a particular financial system is not stable or there is financial instability? So we have to be very mindful and concerned. We have to be on alert when these things are emerging in a financial system. What are these characteristics? First, we might see some important financial institutions are running into a problem. They are struggling, or sometimes even they can be failed, closing down, bankruptcy. So anything can be happen. Especially when most important institutions are failing, that is a key indication of a financial instability. Now, for example, if a particular large bank is falling down or it is failing, then that is some indication of financial stability. And sometimes we see large asset price volatility. For example, in the stock market, the stock index shows very large volatilities, violent volatilities, asset prices. Even the interest rates could show large volatilities, huge ups and downs. These are indications of financial instability. There could be drain of market liquidity. Market liquidity means the money availability in the system. So if there's no money to borrow, which means people are not, putting their money into the financial system. So people who have money, they lock their funds in safe instruments or safe places, and they are not, putting money back to the financial system. So which means the market is becoming dry. There's no money to borrow, and when you don't have money to borrow for your activities, interest rates are increasing rapidly. So that is also another symptom of a financial instability. Disruption to payment and settlement systems. We know payment and settlement systems are the infrastructure for financial transactions. Now, for example, you buy a security and that security is not, settled, which means it is not delivered to you. What does that mean? There is a disruption in the settlement system. You make a payment, a check payment, and money doesn't, flow into the accounts with the check payment. So that, what does that mean? There is a
I
disruption
agree.
payment system. So likewise. Also, another important thing, last but not least, in unstable situation when financial instability is there, you see a lot of loss in the confidence. So investors lose their confidence. Markets are not believing the people are not believing the market functioning. People are not believing the financial, institutions. So there's a lot of confidence failures. So that is also source of instability. I think all these are indications, but the trigger point of a key instability would be confidence. So when the people do not believe, then the financial instability can trigger. Now, for example, if people don't believe banks, and they might run to the banks and ask for their money. So that is loss of confidence that could create a lot of issues. So we need to have financial stability. We have to ensure that financial system is really stable. So for that matter, we can have certain measures in place. So one thing, we have to have better risk management frameworks. So in banks and financial institutions, you have to have very good risk management systems. Not only the financial risk management, also non-financial risk. So both the aspects are important. Non-financial risk means in relation to operations. So there is operational risk management as well. So all these are important to have financial stability. And also regulation and supervision of financial institutions and payments. Regulation and supervision is basically indicating some involvement of the government. So government has the principal, he is the major player of the economy who looks after everyone. So government is basically putting regulation and supervision on banks through maybe a central bank or through some other institution, but there is some regulation and supervision, monitoring of the markets and institutions. You need to have some reforms in place. Reforms means time to time you need to introduce changes. Sometimes some procedures you have to change after a while. You have to introduce new things. You have to introduce some innovations. Some changes have to be done to the financial sector. So those are called as reforms. That is also a part of financial stability, that is supporting financial stability. Improving corporate governance. Governance, I think, is a very common word, good governance, where you need to have better ethical practices in the financial institutions and the markets. You should have to have proper control mechanisms, proper checks and balances. All these are ensuring the financial system stability. And finally, there should be better crisis management policies. Now, the risk management policies are there to prevent a crisis, right? You prevent a crisis through risk management. Crisis management policies are there when the crisis happens. You should be able to manage it. You should be able to have some mechanisms in order to not to aggravate the crisis. So those are crisis management policies. What we are talking about, safety net mechanisms and contingency, are related to this crisis management. Now, this is all about financial stability and instability, and we have seen why it is important, how you can ensure financial uh, stability. Now, there are situations you have extreme instability, or which creates financial imbalances and crises. So, financial instability can lead to a crisis. Instability is a kind of a situation that you can prevent and you can recover. But if it worsens, that could lead to a financial crisis. So in a crisis, what will happen? You will see large loss of asset values. Now, for example, this is just before the global financial crisis, Dow Jones Industrial Index, which means the USA stock market index. So what you can see, before the crisis, the index peaked and then all of a sudden it collapsed. From 14,000 to 7,000, nearly 100% collapse was there. At 50% collapse was there. So what happens when the stock market collapses? You lose value of your assets. Any other financial instrument, this is the same. So you lose the value of the financial assets through a crisis. So that is an extreme situation where you have financial instability. So in a crisis, what you can see, you will see large disruptions, large frictions in the market, and the worst case, the financial market stop functioning. Disruptions are there, frictions are there, then market functioning will be uh, abruptly, which means suddenly stop. And then finally, the economic activity will collapse. So there is really a disastrous situation to have a financial crisis. So why financial crisis could happen? The worst situation of instability. One reason is leverage. So leverage is a very important term which indicates large borrowings to finance investments. People are borrowing or companies are borrowing not to make productive economic activities, but to make investments. People borrow and buy financial instruments. So you call it leverage. What will happen due to leverage? The debt component will increase in a firm or in an economy. So rising debt means always not a good thing. High debt is adversely affecting the firm. Remember, we have discussed last week or week back, when a firm has all equity, all shares, then that firm has very low risk. If a firm has high level of debt compared to shares, it has high risk. So you call it leverage. Leverage, borrowing and investing in securities. High credit growth. There are periods you observe a substantial increase in credit. We are not talking about 10%, 15%, 20% growth in credit, but sometimes you might see 30%, 40%, 50%, 100% growth in credit. Such expansion in credit is not sustainable. Why? Through this credit, there could be price increases in the markets. For example, property prices could increase, interest rates could increase because of high demand of credit. So then at certain point, there could be a collapse of these markets. Asset liability mismatch, I think you are aware, assets are basically Give me a minute. Assets are basically uh, uh, collected as short-term things. We know financial institutions collect assets as a short-term thing. A deposit is a long-term thing, but liabilities are basically short-term. Now, for example, a financial institution give a loan means it's a long-term thing compared to a deposit. Deposits are liabilities which are short-term. We know a maximum deposit is maybe 5 years, could be even 10 years. But loans are given as long-term things. Now, when you don't appropriately align these asset liabilities, that could lead to a mismatch and a risk, right? And some cases we have seen regulatory failures also lead to crisis. Regulatory failure means from the government side, the lack of regulation. The government does not pay serious attention to financial institutions regulation. They don't monitor seriously. They are not detecting any false issues with these financial institutions. So in such cases, there could be regulatory failures. The companies or the financial institutions could be basically violating certain guidelines when you don't follow, proper regulation. So that could also lead to a financial crisis. Weak management of the institutions we have seen, especially during the crisis, most of the financial institutions have indicated weak governance, right? There are no ethical conduct in the market, no proper internal controls, there are no proper checks and balances. Likewise, there are a lot of internal governance issues are there. And also some risk management weaknesses. We have to have proper risk management frameworks in order to avoid the problems. Remember, I told you there are some committees within a bank in order to ensure certain risk management aspects like audit committees, risk management committees. So all these are really important to have a safer financial system. But if there are weaknesses, that could lead to a financial crisis. And related to financial crisis, there's another important concept. Now, the crisis happens because of one important factor. There's a failure only in one institution, that doesn't matter, right? That can be addressed, that can be resolved, and it will not have a major impact on the broader financial market if it is addressed. But the issue comes, the problem arises due to the contagion effect. So contagion means, we know, I think these days this word is very popular, contagion, which means spreading, right? So this crisis may be spreading from one institution or one market to another market or an institution, or to the region or across countries. You call it the systemic risk. Due to systemic risk, the importance of the due to the importance of the size of the financial institution, there could be contagion risk, which is spreading of the financial vulnerabilities and risks across the markets and institutions. So in 2019, this question is on uh, contagion. Briefly discuss the cross-border contagion risk with respect to 2008 global financial crisis. I have given you the answer here. Cross-border contagion risk means the effect or the impact is felt across the borders, which means across countries. Spread of market disturbance from one country to another country or a group of other countries due to financial sector imbalances and the nature of interconnectedness in markets and economy. So in the global financial crisis, it happened. The crisis originally happened in the US market, but later on, it basically spread across other countries in US, in other regions of USA, other countries other than USA like Europe, Asia, Latin America, because of the cross-border linkages between these markets. In modern world, we know markets are not performing in isolation. They are linked one to another market. So that linkages might create contagion effects across markets. So crisis, now it doesn't happen all of a sudden overnight. It happens gradually. So when there is a crisis is emerging, you can actually observe and you can feel it. For example, I borrowed this chart from Mishkin's book. So in this Mishkin's book, he actually, by looking at advanced countries, he basically identified three stages of the crisis, at least. Right? So in the first stage, you can identify certain symptoms of a crisis. For example, people are not paying back, bank balance sheets are deteriorating, asset prices are basically volatile or declining, uncertainty is emerging. So all these suggest some issue is basically emerging in the financial system. If you don't address it at this point, then you move to the second stage where you have a banking crisis, where bank activities are declining, banks are defaulting, they are not paying their depositors, the people are not paying their loans. So all of a sudden this happens, and as a result, the economic activities will also decline. So this will fall into the or lead to the third situation where you are basically uh, having a situation, the full default of a debt, which means people are not paying, and as a result, you are completely in a trouble, and some wind up of the financial institution or some default or bankruptcy is declared at this point. So if it is only one institution, as I said, you can simply manage it. But if it is broader economy and many financial institutions are failing this, that creates a disastrous situation, because that is entirely affecting the economic activity. So what I want to say, the crisis will not happen overnight. There are certain steps that can be seen. And there are various crisis types that we can observe. Mm, I have given you some very brief definitions here for each and every crisis. So the very popular and very frequent crisis in economies is a banking crisis. Sometimes you call it a bank run, where banks are suffering sudden rush of withdrawals by the depositors. So in a bank run, what will happen? All the depositors will run to the bank and ask for their money. At least majority of the depositors. Right? So I think very easily a bank can be, collapse if you see a large queue on a front of a bank. If everyone get together and make a long queue, that creates some uncertainty. Right? People would think, okay, why there is a large queue? What is the problem? So they might develop some suspicion about the bank. So in that case, we have the banks are ensuring that their depositors are not demanding their money back suddenly. So if that happens, the bank run could occur. Now, for example, in 1929, the global financial crisis, the Great Depression in 1929, is basically triggered through a stock market crisis, and that was basically translated to a banking crisis. Banks were required to pay their depositors back. So that is one type. Speculative bubbles means that the asset prices are increasing at a rapid pace, and you call it overpricing. Overpricing means naturally there should be a price for particular assets. You call them as intrinsic value, the market value. But sometimes you might see the prices are basically extremely high, which are overpriced. Securities are overpriced. The real estates are overpriced. So that leads to speculative bubble. Speculative means people anticipate, okay, the prices will increase continuously. Bubble means that they are anticipating prices to increase continuously, and they continue to buy, they continue to demand. So as a result, the prices would increase, but at some point the prices would collapse. So when the prices are collapsing, that could lead to a speculative bubble. Some countries are facing currency crisis. Currency crisis means the foreign currency related crisis. If a bank or a country is unable to have foreign currency for their payments, if the government is not in a position to pay their foreign currency debt, that might lead to a currency crisis. So there is a large decline in market liquidity in a foreign exchange market in a currency crisis. There could be large volatility of the exchange rate when there is currency crisis. So these are some aspects of the currency. Another important area is sovereign debt crisis. I think you may have heard countries sometimes you think the countries are defaulting. So defaulting means what they are defaulting is actually sovereign debt. Rajayana. So what do you mean by a sovereign debt? A country fails to pay their debt for local investors as well as for foreign investors. If it is a default for foreign investors, you may call it a foreign debt default. If you are defaulting local debt, you may call it defaulting for the local investors. You may call it as a local debt default or domestic debt default. So that is a possibility, and we cannot say those are not happening. For example, in the past, we have seen some countries have defaulted their debt. Argentina, they defaulted their debt. Greece, they defaulted their debt. So those could happen, which means governments are not paying. Finally, the worst case is the economic crisis, where the economy is experiencing a negative growth for a longer period. Now, right now, we are facing COVID. We are not so sure whether it leads to an economic crisis right now, because we have seen 1 or 2 quarter was negative. But probably this year, this quarter could become a positive growth, or it could indicate some recovery in the economy. But if we have seen negative growth for many years, that is a kind of an economic crisis. We have seen this in 2020, sorry, 2007-8, 2011 period. We have seen this negative economic growth for many quarters where economic crisis. Now here I have given you some examples for these major crises from the past. I told you the first major crisis we can observe even before there were crises in the world. For example, in 1900 period, there were large banking crises in US. But here what we have highlighted, the crisis that impacted the global economy, major crisis. So that started with, or that starts with the Wall Street crash, which means I told you the collapse in the stock market, and that led to a Great Depression. Now here, if you look at this 1930 period in this chart, you can see a large number of countries experienced the shock of this global depression or Great Depression in 1930s. Then we can see crisis in 1970s, especially the oil crisis. So in 1970s, we have seen oil crisis where the oil prices went up and some markets, stock markets collapsed as a result. Latin American debt crisis can be observed in 1980s. I told you some Latin American countries defaulted their debt. Argentina defaulted their debt. In 1990s, we see Japanese asset price bubble where uh, asset prices in Japan exploded in 1990s. Especially after 1990s, there are few important crises that we can observe. One is Asian financial crisis around 1997. This period, we have seen Asian financial crisis happening. That is actually basically a foreign currency crisis. Asian countries, they observed large foreign currency withdrawals from their countries, and as a result, that led to a crisis. In 1998, the Russian financial crisis was also an important crisis. After the liberalization of the Soviet Union or the breakup of the Soviet Union, many countries experienced a lot of financial sector and economic issues, and that is one of the key crises that we observe during this period. It's a currency crisis. Actually, the Russian financial crisis is a currency crisis. Some people call it a ruble crisis during that period. And then the most important crisis that we can observe in the last century is the global financial crisis. Actually, not in the last century, this century so far. It happened around this period, 2006-7 period. So again, during that period, you can see how the markets were disrupted due to global financial crisis. And then followed by a European debt crisis also happened during this period, where some European countries, they have defaulted their debt. For example, Greece defaulted their government debt, and also uh, some countries like Spain, Portugal, they were facing problems in uh, honoring their public debt. So those are some examples. I have added an annex to this slide set at the end. You have some, information about this crisis, some additional information. So you may read it for your additional knowledge, but I think having some broader understanding is sufficient. But we need to look at some two important crisis situations in a bit detailed manner. One is the global financial crisis. So it happened in 2007-8 period, GFC, and that is considered as the worst financial crisis since the Great Depression. So Great Depression, I told you, that happened in 1930. After that, for last 70 or 80 years, we have not seen a financial or any other crisis, major crisis in the world. But after, there were some crises, but it did not threaten the global financial architecture. The global financial crisis in 2007-8, it impacted the global financial system through the collapse of large financial institutions, decline in consumer wealth, and global economic recession was also emerged. So as a result, many people suffered large losses, especially financial institutions. They suffered a lot. The market liquidity was basically declined. Interest rates and prices were very volatile. Even international trade declined, and that finally led to a kind of a economic crisis. And also, even the European debt crisis was a result of the global financial crisis. So, crisis, why it happened? There were many reasons for that to happen. Now, a crisis triggers may be due to one or two incident. It exploded due to one or two incident, but the vulnerability builds up throughout a period due to a combination of reasons. So if you look at the global financial crisis, the origin of the global financial crisis was actually subprime crisis. Subprime crisis is basically the crisis occurred in the US subprime mortgage market, where average people buy and sell their real estates, houses in the economy. So that is the subprime market. The imbalances happened in the subprime market created the problem. So why it happened? A lot of easy credit, low cost credit was available to the people. So people borrowed in large quantities and invested those quantities in the real estate market, which means housing market. So people borrowed and built large houses and bought more and more properties, thinking that the prices would continue to escalate or increase. So when the prices increase, people think that is a kind of a continuous thing. So people continue to do that because of the nature of the mankind. They when they see an opportunity to exploit, they continue to do that. So similarly, in the US subprime market, people continue to borrow. People continue to put their money in the subprime market, thinking the prices would go up. But at some point, what has happened? The prices collapsed. So the market for housing was basically collapsed. If you look at this chart, at this point in 2006, the housing market was at peak. The prices went to a peak level. These are prices. And then all of a sudden, the prices collapsed by 2009. And that created the problem. Why? People are unable to pay back. Banks are not getting their money back. Loans are not honored. And even the large amount of house supply, you can't sell it. A lot of vacant houses are there. So all these created a massive problem in the US economy. And also last week we discussed this securitization where you identify bad assets and take assets out into a special purpose vehicle. So during this period we have seen increased securitization by the financial institutions. That is also considered as a part of the reasons of global financial crisis. And also ethical practices are that is an issue. We have seen during the crisis there are some questionable uh, trading practices, some unethical trading practices that is also contributed to global financial crisis. And then the availability of money, the credit availability decline. I told you when there is a crisis, the money market liquidity goes down. So when the liquidity goes down, people are in real danger because they don't have money to fulfill their funding needs. They cannot support the economic activity. So all this led to a damage in the investor confidence. As a combination, the financial crisis was emerging. So the crisis, the GFC, led to a significant financial panic in the US during 2008. The financial, but it is not only limited to US, it spread to other markets as well, to Canada, to Europe, to Asia, to Latin America. Towards many countries, the impact was felt, and that damaged the financial institutions globally. And we see some banks have even collapsed. Some very long-standing banks like Lehman Brothers, some investment banks, some insurance giants like AIG, some very famous banks like Northern Rock, right? Lehman Brothers, Northern Rock, AIG Insurance, all these key financial institutions collapsed. Not only one or two or three, I think more than 100 or 200, 300 banks all over the places collapsed due to the crisis. And also the availability of money, the liquidity in the markets that were declined. Credit availability was not there. Investor confidence was basically affected, and the stock markets came down, which means crashed because of the loss of this confidence and of related issues. As a result, we know when the market is coming down, that creates losses in securities. So the firms and institutions, banks, they were experiencing large losses in their security investment. So what really has happened? Economies all over the places. They had to tighten their credit conditions, and also international trade and economic activities declined during this period. So in this slide, you can see the outcome or the impact of the crisis. Now, for example, because of the bank failure crisis, in US alone, you can see large number of banks collapse. More than, if you add up all these things, roughly, I think 400, 500 banks collapsed during this period. The world trade collapsed largely, which means there was a negative growth in world trade. World production, global production of industrial goods collapsed. All these are visible in 2008-9 period in the global economy, and as a result, we have seen around 2008-9 period the global economic growth was negative. So prior to this, I think we have seen negative growth during the Great Depression in 1930s, but due to the global financial crisis, the growth went to negative levels. Markets, I told you, asset markets, there's large volatility you can see during this period, especially 2008 period. The asset market was really tumbling, which means the market was very sharply falling down. So which means what? There are losses to the investors. So people who have, enjoyed the prices here, when you have a collapse prices to this level, you have a significant loss in value. So that is observed. Volatility in the markets went up. This implied volatility means it's a measure of identifying the financial fluctuations. So that volatility index, if you look at during this period, it was peaked, which means high volatility was there in the financial market. So all these suggest the global financial crisis created a significant impact, significant pressure on the financial market as well as on the economy. So for the crisis, there were large responses. Responses were from two parties, the government and the central bank. Both have responded. So how does the government responded? They have given large fiscal stimulus. Fiscal stimulus for what? For institutions, for consumers, for borrowers. A lot of financial injections were done by the government. Stimulus means you are giving some large amount of money at cheap prices, which means cheap credit. So you can do some adjustments to tax policies, which means reduction or removal of taxes and all that, so giving some additional incentives. So those were done by the governments during this period. And then monetary expansions. So this part is done by the government, fiscal stimulus. Monetary expansions were done by the central bank. So most of the central banks, they resorted to quantitative easing, credit easing. I think you remember this term I discussed. Quantitative easing means broadly the central bank is borrowing. Sorry, not borrowing. Central bank is injecting money to the economy through buying government debt instruments. For buying private debt instruments, they can inject money into the economy. So that we call it as QE or monetary expansions during this period. Other than that, institutional bailouts, which means the governments stepped in and saved some financial institutions. So without allowing the bank to collapse, the government comes and nationalizes. So the government comes and take the control of those. So again, that is a fiscal measure, but that was done by the governments in some countries. Now in this table you will see all these what we have here is advanced countries. So their policy responses are basically listed here, giving deposit insurance, funding guarantees, capital injection, banned bank nationalization, uh, unconventional monetary policies. All these are done with a view to minimize the response crisis of the impact of the crisis during this period. So that's global financial crisis, and as after that we have seen due to these massive responses, the global economy started recovering. By 2011, 12, and after 13, we have seen some recovery is there. Some slowdown again has happened after 2015-16 period, but broadly, what we have seen, these policy initiatives during the global financial crisis have helped to stabilize the markets to some extent. Then, other than the global financial crisis, around same period, which means around 2009-10 period, we see European debt crisis. So some European countries, EU countries like Ireland, Portugal, Cyprus, they were basically in trouble due to this European debt crisis. The European debt crisis mainly occurred in Greece. Right? So the Greece was basically having a large amount of government debt, indicating that they have borrowed extensive amount of money, or large amounts of money, and they have used that money not to generate growth or productive activities but for consumption mainly. So that created a long standing or long rooted issue in the Greek economy, leading to a default in public debt during 2009-10 period. So they were unable to pay, and it recorded the largest sovereign debt default uh, in the history. Not only that, usually people borrow from IMF and they don't default. In 2015, Greece became the first developed country to default IMF loans even. So they were under real stress. So what has happened after that? Many institutions stepped in, like IMF, ECB, European Central Bank. They came out and helped the Greek economy through a very painful program. Painful in the sense a lot of controls were introduced, a lot of measures were introduced to bring back the Greek economy to the right path. So with the global crisis and European debt crisis, all these created a negative economic condition in the European region. So the European region countries have been experiencing a lot of job losses, a lot of collapses of financial institutions, and as a result, the decline of incomes and economic activity. So to address that, European Central Bank, they follow a very relaxed monetary policy stance. Even today, still they are following a very relaxed monetary policy stance. Sometimes their interest rates are very low, close to zero, even sometimes negative. Some banks are, some countries are having negative rates also. Large purchases of assets were done by the central bank in order to inject money into the economy. So this is one of the critical crises in the 21st century, other than the global financial crisis. Now, right now, we are experiencing a similar shock, the COVID-19 pandemic. We know it has affected the entire world. More than 3 million people died, more than 150 million people infected by the COVID pandemic virus. So that has created a lot of uncertainty around the world. And we have seen the COVID pandemic had impacted significantly the financial market. So at the early stage of the crisis, we have seen the market was very down and it was collapsed actually. And also we have seen a lot of volatility in the financial markets due to the COVID pandemic. So the global economic growth is also affected due to the pandemic. Now the global growth is projected like, for 3.3 contraction in the 2020, although there will be some recovery. Although this was basically some shock to the global economy at the initial phase, now we see the global financial markets and economies are basically stabilizing in view of COVID pandemic. And we know a lot of countries, they have normalized their economic activities, even though the pandemic is there. A lot of countries, they are relying on a lot of government support, monetary policy easings, government money injections, tax cuts. A lot of support is there from the government. And in addition to that, I think hopes have been added due to the vaccination programs. I think a lot of countries are looking for vaccinations. With all that, some stability is there in the financial markets and the economy. But there were some uncertainty sometimes. So we can hopefully, due to the pandemic, the global financial market will not be threatened that much. There will be some impact, but it will not be serious. So as I said, in response to the crisis, a lot of responses are there. As I said, the governments have responded largely, and also central banks have responded through their loose monetary policy. So the monetary policy is very loose. How do you know it? The Fed funds rate right now, it's very close to zero. Yeah, actually close to zero. So a lot of countries have relaxed their monetary policy stance. If you look at this chart, almost all countries have relaxed their monetary policy stance. This yellow area indicates monetary policy relaxation, where interest rate cuts. So interest rates cuts, a lot of liquidity injections, a lot of regulatory concessions, a lot of things were done by the central banks during this period in order to come out from the crisis. Okay, now come out from the COVID related impact. Now, before I move to the next part, regulation, let me ask you whether you have anything to be clarified in this part. I was just talking for about 1 hour. Do you have anything to be clarified? Is IBSL open for paying exam fee? And also, can we get the past papers from IBSL? As far as I know, these days IBSL is closed because I think the issue of the COVID, and I heard the IBSL is closed for some time. So what you can do, please give them a call on Monday and see when they are going to open and whether you can access the IBSL premises physically. Right now, I think it's closed. They're operating from home. But for sure, that you might be able to pay your exam fees or whatever through kind of a online payment, bank transfer. Talk to them, please. Any other issue? When do we have exams? As far as I understand, exams will be in July. Earlier, I think it was planned for June, but I think I came to know last week it will be basically end of June or in July. Ezra is asking question, has Sri Lanka faced a financial crisis before? Good question. Sri Lanka has never faced a financial crisis. Crisis in the sense, as I said, large collapse in the value of assets, collapse of financial institutions. That has not happened in Sri Lanka for at least for last 70 years. But there are some instances of instabilities, especially not in the banking sector, especially in non-bank sector, we have seen some unstable situations. And during global financial crisis 29-10 period, there were some, vulnerabilities in the banking sectors as well. But other than that, we haven't faced in a kind of a full-fledged or a kind of a full-scale crisis. We haven't experienced, luckily. Okay, any other question? Right. If not, let's move to the second part of our discussion, safety nets. On safety nets, financial system safety net and regulation. So you can call it broadly financial system safety nets. Now, what do you mean by a safety net? I think to understand a safety net, the best example is basically a safety net in a circus arena, right? You may have seen a circus arena where uh, uh, people are performing in air in a circus, and underneath or closer to the floor level, you have a kind of a net, right? Made by maybe by thread or whatever, wires or whatever. There's a kind of a net. Why is that? Why the net is there? If someone falls from the circus, that net will be acting as a protector, life saver. So in a financial system also, we have such nets where when people are facing shocks in the financial system, to safeguard them. So these safety nets are acting as a kind of a protection mechanism, safety net or a safeguard for the financial sector stakeholders. That is needed. Why it is needed? If there is no such a framework, the people will not have confidence to take financial decisions. Uh, people not will have sorry, people will not have confidence to undertake their financial decisions, and also people will be basically having some uncertainty in the financial system. They are reluctant to make decisions. So as a result, you need to have certain elements that ensure safety in the financial system. So what are these elements? You can look at various components in a financial system. What are these components? You have effective bank regulation and supervision. So one element is to ensure financial stability is regulation and supervision. Then you have capital, capital as a buffer. I'll come back to these one by one. Then you have lend of last resort facility. Again, it's a kind of a protection for the financial institution. And then we have deposit insurance and liquidity support scheme. Right? So all these are acting as a kind of a buffer in the financial system. Sometimes you can also add crisis resolution plans. Right? That is also a component. Crisis resolution plans. So all these are basically forming components of the financial safety. Now let's look at these safety nets one by one. Regulation. Now regulation means basically a certain entity is performing some monitoring and supervision activity by way of issuing certain rules and regulations. For example, a central bank is acting as a regulator to the banking system. So what is the role there? Why do you need regulation? Regulation, you need to prevent or safeguard the depositors. Their money have to be secure. So you have to prevent the financial system failures. For that matter, also you need regulation. And then you need to facilitate to adhere, encourage financial institutions to have some proper risk management practices. Because finance is always risky business, and you have to have some systems that ensures that they are not open for certain risks. You need to have good governance culture. Corporate governance is one of the key areas in modern financial system. So in order to ensure that the banks or the financial institutions are run with proper corporate governance principles, you need to have regulation. To have market discipline, and for disclosure means you publish your information. You need to have some regulation. And in modern context, money laundering is also an important thing. Unlawful economic activities are happening. Money laundering means adding illegal money to the financial system. That has to be prevented. For that matter, also regulation is done by government entities, and also to have fair treatment for customers and as a social responsibility, ensure that the regulation is done. Now, here I have taken some exam questions to give you some idea about what sort of regulation that we have in a financial system. So in a financial system, there are two types of regulatory models. One, single regulator model. The other one is multi-regulator model. Actually, this is a exam question from 2019. So what do you mean by single regulatory model? There will only be one regulator to supervise and monitor the entire financial system. For example, in Singapore, they have one regulator for banks, insurance companies, capital market. Everyone is monitored by one regulator. You call it a single regulatory model. In a multi-regulatory model, there will be more than one regulator for different financial segments. Now, in Sri Lanka, we have a multi-regulatory mechanism. Why? Banks, non-banks, primary dealers, they are regulated by the central. Capital market is regulated by the Securities and Exchange Commission. Insurance sector is regulated by the insurance board. Likewise, there are various multiple regulators in Sri Lanka. So both models are common or can be seen in many countries, right? So the second question, list institutions that comes under the purview of Central Bank of Sri Lanka and Securities and Exchange Commission. So under Central Bank of Sri Lanka, what do we have? We have couple of a large number of institutions supervised by the central bank. What are these institutions? Licensed banks, both commercial banks and specialized banks. Then we have finance companies. We have leasing companies. We have primary dealers, money changers. You can also add AMBs. AMBs means authorized money brokers. So all these financial institutions are supervised by the central bank. Not only that, these are financial institutions, FIS. There is financial infrastructure also, FI, monitored or supervised by the central bank. For example, I think so far you have some knowledge on the RTGS systems, CIT systems, SLIPS, not CLIPS, SLIP system, SEF system. All these are systems which are used to do financial transactions in Sri Lanka. So these are actually supervised and monitored by the Central Bank of Sri Lanka. Securities and Exchange Commission, that is broadly related to the stock market, right? Stock market, which means the capital market activity. In the stock market, they have the stock exchange, CSC, and they have stock brokers, stock dealers, rating companies, CDS, Central Depository System. All these are monitored or supervised by the Securities and Exchange Commission. Other than that, we have IRCCSL, which means Insurance Regulatory Commission of Sri Lanka. They are monitoring the insurance sector. Some other banks are not monitored by the central bank. Now, for example, Divinaguma Bank. It's not coming under central bank. It is under a ministry. Samupakara or cooperative banks, they are not under central banks. They are coming under a ministry, right? So likewise, there are some institutions not under the purview of the central bank or SEC, but broadly, in closer to 99% of the financial institutions are supervised or regulated by the central bank and the Securities and Exchange Commission. So that is one aspect, single regulatory and multi-regulatory model. The other aspect is micro-prudential regulation and macro-prudential regulation. So micro-prudential regulation means very simply regulating or supervising individual institutions. Each and every institution, let's say if you have 25 banks, you monitor 25 banks individually. You regulate 25 banks individually through microprudential regulation. Why it is needed? To ensure that particular financial institution is stable and sound and they are operating in a good manner. That is the need, or that is the requirement to have this microprudential regulation. So when you have microprudential regulation, that is based on the laws introduced by the central bank, or basically the directions, circulars introduced by the central bank or the Securities Exchange Commission, and also various requirements. If there are banks, there are various requirements to follow. Capital requirement is there, liquidity requirement is there. You have to make certain provisions for non-performing loans. All these are coming under microprudential regulation. Then we have macroprudential regulation. Now earlier we were only looking at one institution, but under macroprudential regulation, the word itself indicates we are looking as a whole. So the financial supervision is done as a whole, and you look at not only one institution or two, you look at the sector as a whole, banking sector as a whole, insurance sector as a whole. So it is supervision more than at individual firm level. So why do you need it? Now through microprudential supervision, you identify the risk related to that institution. Through macroprudential measures or regulation, you identify the systemic risk or systemic shocks that may arise due to certain things. So in order to address these systemic risks, the macroprudential tools are used. I hope you remember we had a discussion on these macroprudential tools used by a central bank, why they are needed, what's the type of tools we have. Right? We have a lengthy discussion under central banking subject topic. So I really recommend you go back and look at what are these macroprudential tools. Right? Second type of safety net is capital funds. Now capital means basically the money brought by the lenders and equity holders to the business. Right? Actually, it is more appropriate if we say money brought by the equity holders. That is the capital, right? So these equity holders are actually owners of the business. They are putting money. That equity capital has two components, or the capital has two components. One, equity. You call it stated capital. The other part is reserves. So both are forming capital. So reserves means there are some statutory reserves. If you are an accountant, if you have some accounting knowledge, you might know there are some reserves that have to be maintained by an institution or a bank. There are some retained earnings, sinking funds. So all these are kind of reserves, part of capital. Equity means what the people have already bought into the business, as I said, the stated capital. So until such time, this capital was not considered as very important factor, although it is important. But under the Basel framework, I think you may have heard this term under your commercial banking subject. So Basel framework is very much concerned about the capital. So Basel 1, Basel 2, these frameworks were in the past. Time to time, the Basel frameworks have been introduced. One was introduced, then two was introduced. Currently, Basel 3 is in place. So currently, banks are required to adopt Basel 3, and under Basel 3, they need to maintain capital uh, as per certain guidelines. So what type of capital they have? So one type of capital is actually uh, regulatory capital. So under Basel 3, bank should have certain level of regulatory capital. Regulatory capital means it's a certain percentage of your assets. So that regulatory capital has certain elements. Here I have put up here: common equity, capital convention buffer, tier 1 capital, total capital ratio. Likewise, there are various definitions which I'm not going to cover. What I'm really interested in the minimum capital requirement. So the bank should maintain at least a minimum level of capital from their assets, out of their assets. Why this needed? This is needed if the bank is facing losses due to defaults of loans, so that losses have to be absorbed by the capital. So capital is acting as a buffer to absorb the loss. So that is needed. Otherwise, what will happen? When there is a large loss, bank is not in a position to absorb it. There is no cushion. So this minimum capital requirement is like a cushion. So how do you calculate it? Simply, total risk-weighted assets. You take the total risk-weighted assets and the total capital as a ratio. So here I have highlighted here. Total capital divided by total risk-weighted assets into 100. Now here we have a question from 2019. The bank's total risk-weighted assets and the total capital as at such date is 15,500 and 2015. Compute total capital adequacy ratio. You call it total CAR, right? So if you want to calculate CAR, it's a matter of taking capital divided by risk-weighted assets. So in this question, you simply divide 2015 by 15,500 into 100. So it is roughly 13%. Now this 13% seems a good level of capital. Now under Basel requirements, there are certain thresholds are given. Countries can define their own threshold. Now, for example, we might say that risk-weighted capital should be minimum 12%. I think in Sri Lanka 12%, I can't exactly remember. But let's say it's 12%. There should be at least 12% risk-weighted capital. But in this case, this bank has 13%, which means it's above the minimum level. So minimum requirement means that doesn't mean you have to have that, right? At least they should maintain such level. So currently, any commercial bank and licensed specialized bank should maintain this risk-weighted capital under the Basel requirements. Not only under Basel requirements, some other for let's say for non-banks also there are some requirements that they should maintain. So capital is an important. So second aspect of capital is minimum capital. Minimum capital means you call it as startup capital, right? Not a ratio. The bank should have at least this much of capital at the start, or gradually they have to build it. Now in Sri Lanka, minimum capital for new banks is given like this. What are the levels? Domestic commercial bank should have 20 billion rupees. Domestic specialized bank should have 7.5 billion rupees. Foreign bank should have 10 billion. So what does that mean? If you want to start a bank, business of a bank, you have to, in order to start, you have to have this much of money as capital, right? So under the current regulations, the central bank has directed the existing banks. Now we have roughly 25 existing banks now. So they should reach these capital levels at a certain point in time. Earlier it was extended up to 2020, but I don't know now what is the deadline. But broadly, they should have this much of capital, 20 billion for LCBs, 7.5 for LSBs, and foreign banks, depending on the size of their assets, they should have 5 billion or 10 billion as minimum capital. Now, this is in money, right? Earlier one, it is a ratio. So both types of capital requirements are there in the as the safety nets. Next one, third safety net is the lender of last resort. Now, last resort means when there is no any other option for a financial institution, there should be a last option for them to borrow. Last resort means that if a particular financial institution in trouble, if the market knows, they will not lend to these financial institutions. Now, in that case, they will be in trouble. Why? They are not in a position to fulfill their liquidity needs, money needs. So it could lead to a collapse of that institution, and also due to contagion, the entire financial system could be in trouble. To prevent that, the central banks mainly providing the last resort facility, which means providing loans to financial institutions or banks who are experiencing difficulties. Right? Why this is needed? To secure the financial system and also to retain the public confidence. Now, even a country can have a last resort. Now, for example, IMF is acting as a last resort for countries. Let's say we are not in a position to pay our debt or whatever, we are under real stress as a country. So the last resort we have is the IMF. You can go and ask money from the IMF. Can you help us? Can you save us? Right? So likewise, these are called as the last resort facility. Fourth one, deposit insurance and liquidity support schemes. Now, deposit insurance means by name giving some protection to the depositors in the case of a failure of a financial institution. Now, many countries have this mechanism. Depositors are safeguarded through a deposit insurance scheme. Who are contributing to this deposit insurance scheme? The financial institutions. They are giving some contribution to the fund, and that fund is actually growing as an insurance fund. In the case of a failure of a financial institution, if the central bank or the financial authority has basically directed to close down the operations of these financial institutions, the depositors are paid, their liabilities are paid using this deposit insurance scheme. It also has another part, liquidity support scheme, which means these financial institutions are contributing to the fund. No. If they have a problem, not only the depositors, if they have a problem, they also can ask for some support from the liquidity support scheme. Now, without going to the last resort, they can have support from the liquidity support scheme, which means some short-term money injection to the financial institution. Now, in Sri Lanka, we have SLDILSS, which means Sri Lanka Deposit Insurance and Liquidity Support Scheme. This is a very important initiative by the central bank and the government to support the depositors. I think you are aware, during last few years, we have seen a lot of finance companies have fallen or they were closed down, bankrupt. So what the central bank has done, basically directed these companies to close down and transferred their asset, sold their assets, and customer or depositor money has been paid. Even the deposit insurance schemes money was used to pay these depositors. Right now, in Sri Lanka, the maximum amount per depositor that can be paid as compensation is around 600,000 rupees. Earlier it was 100,000, I think, then it was increased to 300,000. Now it is 600,000. Now, even if you have millions of money, what you get is 600,000 as the maximum. But you might think, so then this is useless. Why? The maximum is 600,000. But believe me, most of the deposits, I think 80%, 90% of the deposits are covered by this 600,000, which means most of the people have very small amount of deposits as they are saving. Very few people have millions or billions of money as savings, but only a handful of people. But large amount of community or the people, they are having small amount of deposits in their accounts. So this 600,000, I think, covering most of their deposit. Now it is ideal if you can expand this, but for that, the fund has to be expanded. The deposit insurance fund has to be expanded. Right now, as I said, banks are part of this deposit insurance schemes, which means LCBs, LSBs are part of this deposit insurance scheme, and also finance companies, LFCs. They are also part of the deposit insurance scheme in Sri Lanka. I couldn't tell you in the case of lender of last resort in Sri Lanka, we have lender of last resort under Monetary Law Act, right? Monetary Law Act is the law for central banking. There you have this facility defined at a particular interest rate. I hope you remember this interest rate, bank rate, right? So the bank rate is the rate applied to pay or to give money under lender of last resort rate. Now this bank rate is linked to the SLFR rate, standing facility rate, that plus I think 300 basis points. So that is changing according to the changes in monetary policy. The lender of last resort in Sri Lanka is provided at the bank rate. Now here in this question, I think I have taken this from a past paper. You would see there are a lot of areas that question, given as a question in this part in terms of regulatory ratios stipulated by central bank. So what are the regulatory ratios that we have in terms of capital, liquidity, leverage? These are some of the things that you should know. So under capital adequacy, we already know there should be risk-weighted asset based regulatory capital ratio, right? We already discussed. And also we discuss minimum capital requirement. Right? So these are some of the measures that we have. Under liquidity in Sri Lanka, there are some important ratios. One of the important ratios is the SL AR, SLA, statutory liquid asset ratio. So bank should keep a certain amount of liquidity in a certain amount of securities in liquid form, which means money, treasury bills, and short-term instruments. In the case of a liquidity issue, you can encash these very easily and pay your customers back. So that is one of the key ratios. Under leverage, the banks are required to maintain a leverage ratio. Right? Leverage ratio means, I think, very broadly you can define the debt to equity ratio. That is basically one of the key ratios used in the financial or the banking industry. I think the risk, we have covered risk in the past, the discussion related to risk. But if I simply give you an answer for this question, reliance on technology, what are the risks coming out due to the reliance on liquidity? I think we are aware there could be various risks like cyber security risk, hacking, right? There could be terrorist financing risk. There could be due diligence risk. Due diligence means you don't know who's the customer is. If you are getting money to the account, probably you might not be able to identify who's the sender of money. So that risk is also there. Money laundering risk also there. Right? People could use technology for money laundering. That is also there. I already mentioned to you information hacking. Right? Could be stolen your valuable information, unauthorized access to your accounts. All these could be due to this technology driven financial uh, transactions. Now, our important part in this question is related to our previous discussion is the third part. Fill in the blanks based on the regulations applicable to Sri Lanka Deposit Insurance and Liquidity Support Scheme. Right? Now, these questions are actually, each question has 1 mark given in this paper. So the first part is license bank. Reporting frequency is basically quarterly, which means every quarter they have to report to the deposit insurance scheme. Reporting means the level of deposits, and based on that you have to make your premium, right? And then registered finance companies or licensed finance companies, they should do it monthly. The reason is you consider finance companies as much riskier than the banks, so that's why you have much higher frequency. Capital adequacy is only applicable to licensed banks in the case of this, and premium per annum. A finance company, a licensed bank should have a premium of 1.1% of deposits, right? 0.1% of deposits. Finance companies, they have much bigger value, 0.15% as the premium, right? Because as I said, since they have higher risk than the banks, their allocation is little bigger compared to licensed banks. Maximum compensation, I told you already, 600,000, 600K. So that is the current maximum amount paid under this deposit insurance scheme. Last thing I want to highlight is the credit rating. Now, credit rating is related to this discussion because the credit rating will give us a clear picture about a financial institution or a market based on the credit risk, right? The most significant risk in a financial system is the default risk, right? Default risk means people are not paying. If it is a deposit, default. If it is a bond, there could be defaults. So to avoid this credit race, you do credit evaluation, kind of an evaluation based on a numeric exercise. So this credit evaluation, you call it credit rating. What are you evaluating? Basically, the credit worthiness. Worthiness means whether they are good enough to give a loan. That is the idea. If it is a customer, you assess the credit worthiness to see whether he is good for give a loan, whether he is able to pay back, whether he is having sufficient cash flow, whether he is having a good track record. Likewise, you take both quantitative and qualitative information, also macroeconomic factors and debt profile, a lot of information, and do a kind of an evaluation on the ability of repaying. So the credit rating can be done even for a company, even for an individual investor, even for a country. This country credit rating, you call it sovereign rating. Sovereign rating. So there are different agencies doing this. I think you have heard these names. The most famous credit rating agencies, there are three agencies in the world: Moody's, S&P, and Fitch Rating. Those are the most important credit rating companies. They are giving various, they have various evaluation methods, analytical methods to assess the credit worthiness of the uh, investors, or as I said, even the countries. So they assign certain numerical values for the credit worthiness. For good credit worthy people or institutions, they have higher rating like A, triple A, double A, whatever. Depending on the institution, it could be different, right? They use double A, simple, capital A, simple AA, Moody's. But if you look at Fitch, they use three capitals, triple A, double A plus. They use Moody's use AA1. Likewise, their numeric representation is different. But if it is A grade, that indicates it has good credit worthiness. So if you go down in this table, your credit worthiness gets reduced, which means the risk is increasing. Now, if it is triple A, the risk is low. Low risk means interest rates are generally low. If it is going down in the table, you increase the risk, which means interest rates are also going up. So countries like us, we cannot have low interest rates to borrow. We have to pay high interest rates because we are at lower levels. Right? Even, recently Sri Lanka was downgraded to C grade. So which means we have some uncertainty or some issue in, they perceive some uncertainty in our credit paying ability. There are some situations you are here at very low levels, right? Which means you are at default stage. Some countries are at that level. They are unable to pay. For example, as I said, Greece, they were put it here at some point because they were unable to pay. So this credit rating is really important for a bank, for a financial instrument, for a financial market, for an individual or even a country, in order to assess the ability to pay back, because the rational investors will look at these ratings when they make decisions, before they make decisions, right? So with that, we are done with our discussion, and as I said, I have given you some definitions to each and every crisis: banking crisis, speculative bubbles, currency crisis, sovereign default, recessions, then examples: Wall Street crash, oil crisis, Latin American debt crisis, Japanese asset price bubble, Asian financial crisis, Russian crisis. All these I think I have explained sufficiently. But if you have more idea, or we need to have more information, you can refer to this annex, right? So with that, we are done with our syllabus, right? All the required areas have uh, uh, all the required areas are actually uh, covered under this discussion. Basically, I wanted to have some discussions in relation to certain exam questions. But right now, the time factor has become critical, which means we are not in a position to have a detailed discussion on some exam questions, but hopefully what I have discussed in the class based on the some exam related questions, I think that gave some uh, level of, I think, confidence for you to answer certain questions, and also some of the model questions that I have prepared and answered are, I think, helpful in this case. Uh, right. Now, let me spend few minutes. If you have, since this is our last session, do you have any other areas or questions that you have to be, I mean, have some clarification before we uh, wind up? Okay. Now, I think a very good point was made by Diluka uh, under this deposit insurance scheme. She says now the deposit insurance scheme changed to maximum compensation of 1.1 million, which is correct. Which is correct. Actually, now uh, uh, in the case of deposit insurance scheme, the standard payment was up to now 600,000, right? What really has happened, because I didn't mention it specifically, and actually I didn't bother about this increase because that is the standard payment. But as I said, you are aware, recently there were some cases against certain financial institutions which have been closed down. I don't want to mention the names. And for these institutions, there were some, ongoing cases were there. And at the end, there were some decisions made to pay some additional amount for these legal beneficiaries out of this, for these deposit holders. So as a result, for 5 companies, 5 or 6 companies, I can't remember exactly the number, the central bank has decided to pay the compensation at an increase 500,000. So in addition to this 600,000, another 500,000 is paid as the compensation under Sri Lanka uh, insurance, sorry, deposit insurance and liquidity support scheme. So it is actually right now targeting the failed finance companies, right? But I'm not so sure. I haven't seen any particular circular relating to other entities, but it should be the case. If you are paying for one entity, I think it should be the case for other entity. So I think there's no harm in the exam if you see this question writing 1.1 million as the maximum compensation that you can pay, right? So I think that's a very good point Diluka made. Thank you for raising that. That is actually came out because of the finance companies issue. Any other issues that we need to clarify or discuss? Can we have your email address? Okay, I'll give my email address. No worries. If you have any issue, you can drop me an email. I am writing it here in the chat box. anilra@yahoo.com. To join the central bank, do we need a university degree? Now it's like this. I think for the staff class, joining the staff class, you have to have a university degree with a, I think, second class. But I think there are some university equivalent courses. For example, I think sometimes back IBSL qualification was considered as equivalent. I'm not so sure right now. Some of the other professional qualifications like CIMA, CFA, they were considered as equivalent. So there are some instances you have some equivalent qualifications. But in general, a university degree is the basic qualification in general. But there are some certain areas that you can have a equivalent qualification. I'm very sorry, we are not allowed to share our mobile or phone numbers. So if you have any doubt, please send me an email. We can help. So if you are unable to sit the exam in July, definitely you can go to the next level. How to get the IBSL degree? I think that's the next level. When you have the diploma, I think the degree level program. I'm not so sure. Is it already started? The degree level program? I think they had a plan to start. So when you have the diploma level, I think it's very easy that you can enter into the IBSL degree program. Any other questions? No? So can we stop at this point? And I really enjoyed teaching in this class. I remember there were really active students. Every week when we were discussing, I think there were some students, they were contributing to the discussion. I really appreciate that. Even I can mention them by name. I know who have basically actively contributed, and I really thank them for their continuous support in having a kind of an interactive session. I remember a lot of students, they were doing calculations, providing answers, discussing, and I really appreciate that. Kept the class very lively program. I think it's a really difficult task teaching online. I'm just looking at a computer screen without seeing you. But I think this was a very, I think, a successful program. I remember from the beginning, there were around 100 plus people. Even some people, they could not attend the sessions. Later on also, I have seen a lot of people joining the class, and I heard a lot of people are watching these videos even later. So it was a very successful class. And even other people, even though they did not contribute by active participation, at least they kept quiet and helped me to do the lecture. So I thank everyone. This is a very difficult, tough situation that we are facing, and we understand everyone is really stressed and affected by a lot of issues. It's not an easy thing. I mean, even learning through this online mode, I really understand it. And we need to have, I think, proper movements going here and there. We need to have some relaxation. All these matter when it comes to study. So we are very much limited with all these alternatives or opportunities. That is a real problem. But we have to be satisfied with what we have right now. So if this has happened 10 years, 20 years back, we won't be able to have this active, interaction through the internet media. But at least to our satisfaction, to be happy, we have some way of interacting. So that is helpful and that is really useful. So I really recommend you take this time as God given time. Take this period as a kind of a challenging but useful period. Do your work best. I see some people, I don't know why they are looking for the next semester exam, but I really recommend you do the exam, you do it now, and you have time, you have, I think, energy, you have the wish, courage, and everything. So I really recommend you do it. And I really wish you all the best and in all your endeavors, not only the exam, in your career, in your profession, in your studies, in your personal life, everywhere. On top of that, we are passing a very tough time in our lifetime. This is a lifetime experience. I think a generation would experience this kind of a situation. So it's a very challenging and difficult period that we are passing. So you have to be very careful yourself and your family, your loved ones. You have to be very careful during this time. Be responsible, right? One of the key issues that we see, the irresponsible behavior of the people have put into this situation as a country. Not only the people, a lot of responsible people are there, but we have a responsibility as citizens, I think, to be very uh, careful and also adhere to all health and guideline, all related guidelines, and to be very responsible citizens. So with that, let me finish the discussion. Again, all the best and stay safe. I really thank you and I really enjoy this course. All the best. And probably I will see a couple of you, or maybe sometimes all of you, in the revision program. The revision program is planned as a kind of a physical session. I don't know what will happen right now. Earlier, the plan was to have physical sessions in month of June, but I don't know right now what will be the plan. Let's see and let's be very hopeful and let's try to meet someday. At least if we don't meet physically, if you meet me again someday, um, I mean physically, let me know that you were one of my virtual students, right? I would be really happy to know uh, uh, and see you actually. I'm not so sure. Some of the students I only see the photograph. I'm not so sure whether, I mean, who are these people. I really love to see you in person. So talk to me if I meet you at the IBSL or wherever in this small country, uh, in this small world of financial market. Let me know. Talk to me. Okay. All the best. Stay safe and God bless. Devan Saranai. All the blessings are with you.